Hello, everyone, and thank you for joining us. My name is Amanda Kramer, and I am the Alumni Engagement Program Manager at the University of Colorado Boulder's Leeds School of Business. Welcome to another COVID-19 webinar series. These are certainly trying times, and here at CU Boulder, we have gathered our world-renowned faculty and alumni to provide frank and timely insights for life during and after the COVID-19 pandemic. Today is the final webinar in this COVID-19 related webinar series. Please stay tuned for more information about our forthcoming fall webinar series. For today's webinar, we're so excited to welcome Leeds Senior Instructor Harry Starn here presenting Personal Financial Planning during the COVID-19 crisis. A few housekeeping items before we begin. First, if you have any questions now or during the presentation that you would like to ask Harry, please send a question through the Q&A interface. We will monitor questions as they are submitted, and Harry will respond to them at the end of the presentation. As a reminder for optimum audio quality, we do have everyone on mute except for myself and our speaker. If you experience any technical difficulties during the webinar, please notify us through the chat interface, and one of our support specialists will touch base. Lastly, a link to access the webinar recording will be sent to all registrants tomorrow, along with a survey link and supplemental resources from today's presentation. Now, I'm excited to introduce today's speaker. Harry Starn Jr. is a senior instructor at the Leeds School of Business at the University of Colorado Boulder and serves as the director of the Personal Financial Planner program. He holds industry certifications as a Certified Financial Planner, CFP, and Chartered Financial Analyst, CFA. He served on the CFP Board's Council on Education from 2012 to 2015 and co-authored the 11th edition of Practicing Financial Planning for Professionals. Welcome, Harry, and thank you so much for being here. I'm going to hand the webinar controls over to you now.
So thank you, Amanda, for that. And everyone, welcome to today's conversation on personal financial planning during the COVID-19 crisis. Let me go back here, get started where we were. Okay, let's begin by framing the purpose and the activities of personal financial planning. Dr. Rosalind Overton, in her doctoral thesis, came up with a useful one-sentence description of personal financial planning. In that, she described personal financial planning as the strategic management of economic and financial resources to achieve goals and objectives in a manner consistent with your values. In other words, financial planning is all about getting you to where you want and need to go in a way that you're willing to get there. The process itself includes numerous steps. 1, understanding your current circumstances. 2, identifying your goal, priorities, and objectives. 3, analyzing your current plan, including all the pieces of the financial planning puzzle. Cash and debt management, education planning, insurance planning, risk management, education funding, investments, retirement planning, and estate planning. Looking at that, you start to synthesize revisions, you implement the revisions, and then you monitor and adapt. This process is dynamic. Why? Because life happens and your goals change. The coronavirus has created an unprecedented financial strain on a number of our population. Prudential Financial reported the findings of their May 2020 financial wellness census, and in that they said that over 50% of the respondents said they were negatively impacted on their household cash flows. 20% reported household income reduced by 50 or more percent, including 17% lost employer retirement benefits, 14% lost employer health care, 10% lost group life insurance. The groups that were most impacted by this were minorities, women, the younger generation, and small business owners. Causes of this financial loss included reduced work hours, furloughs, whether partial or full, small business failures, the loss of opportunities for independent contractors, and the inability to work due to either coming down with the virus or helping family members who have contracted it. For some, their job continues. But the stability of that position, that income may be in jeopardy. A few years ago, I was co-teaching a capstone course with Elizabeth Jatone, former president of the Financial Planning Association. And during that, she shared an insight with the students, which is very useful, relevant today. And she said, well, given uncertainty, what we try to do with clients is control what we can and manage what you can't. Over the next 30 minutes or so, we'll explore that insight in context of action steps, planning steps that you can take under the current crisis. They include identifying your goal priorities and needs based on your financial circumstances, taking proactive control of your cash flows, including prioritizing payments, controlling discretionary spending, leveraging government and employer benefits, identifying ways to conserve cash, including restructuring of debt, national and state government support, other ways, so we'll look at that. Building adequate emergency funds, managing risk exposures, particularly those exposures which are catastrophic, potentially catastrophic. Continue to invest, if possible, and embrace supportive mindsets. Now, typically, with financial planning, you are goal-oriented. Your goals include a combination of short, intermediate, and long-term goals. Integrative planning is figuring out how you can use your cash flows to optimize that range of objectives. During the crisis, the focus may need to shift to short-term goals when your cash flows are either constricted or restrained, right? So the focus may then become on making sure you have enough money for living expenses, food, utilities, making sure you be able to pay for health care. And so that becomes the first step that you need to think about the situation. In that regards, if in fact you do shift to the short-term focus, managing cash and debt becomes paramount. And the CARES Act provided some relief. Now, when we think about budgeting or the idea of managing your spending and savings plan, it really starts with understanding your income. What are your sources of income? How much is it? What's the stability? And from there, once you have that idea of the money coming in, how are you going to use that money? You're in control of it. How much will go towards fixed expenses, those expenses which remain constant every month? Those variable fixed, those ones which are again fixed, but you have some control, like utilities, the amount of food, what you spend on food, and discretionary. Finally, within that idea, understanding what are your wants and your needs. Let's start first with income. As you saw, many individuals have had their cash flows disrupted. So how can they replace those missing dollars? One becomes unemployment income. And we'll be looking at these over the next few slides. State unemployment income plus expanded unemployment benefits, longer period of time, plus supplemental income through the CARES Act. Retirement assets, they're there for retirement. However, you have the ability to tap those assets, pull them down to support those missing dollars if that is critical. The CARES Act has provided some additional benefits in this area, including hardship withdrawal, some benefits related to those, and also increased ability to plan loans. You may have to assess your credit situation. What credit do you have out there, and you start to pull down? And finally, there are other items. Clearly, if you're leaving a job, there might be severance, there might be vacation days, there may be other leave time in there, or your plan may provide for access and borrowing against the cash value of life insurance, using your HSA accounts, maybe reverse mortgage, or claiming Social Security benefits if you're 62 or older. Now, this slide offers an idea of unemployment benefits. You can see Colorado has, on average, $458 a week in unemployment benefits. This was designed to go for 26 months. that $458 represents about 52% of someone's paycheck. Of course, it's going to vary a little bit, but to give you an idea. Now, the CARES Act expanded the unemployment benefit and expanded it an additional 13 weeks. Once the 26 weeks end, as you can see there, the Fed will come in and supply another 13 weeks of unemployment compensation to the eligible individual. Also, the federal government is providing $600 per week in unemployment supplemental benefits for those who qualify from April 5th through July 31st. So now we're only about a week and a half to the end of that $600. That $600 has been really critical to a lot of people. Right now it's in discussion in Congress. I can't report today whether it's going to be extended, but clearly that's one of the items that they're talking about. And also, it provided unemployment benefits to individuals who typically did not qualify under the state laws. Also, anyone of you who filed income taxes or claimed Social Security automatically received those stimulus checks back in, what was that, April? And you can see the amounts right there. By the way, the stimulus check is not considered to be taxable income, but those unemployment benefits are. Another way is to replace those missing dollars is to use some of your retirement assets. And the CARES Act, again, provided some additional benefits. One, when you take money out of a plan early before 59 and a half, there's a 10% penalty, early withdrawal penalty. That 10% penalty has been waived for withdrawals of up to $100,000. Also, there's a 20% withholding. The 20% withholding has been waived, so you could just get the money out of that without leaving that for taxes. But remember, there is going to be ordinary income on any of your retirement assets which have unearned or your earned income where you're not taxed on that yet, and any contributions that you made on a pre-tax basis when you had the benefit up front or the employer provided the contributions. So that's available for employer plans and also your IRAs, up to $100,000 for the year. Qualified plan loans were typically the lesser of 50% of vested funds or $50,000. That's been increased to $100,000 and or 100% of vested funds. Repayment of those loans, for a plan loan, you typically start to repay that within a few months. That has been suspended for a year. And existing plan loan payments are also suspended. So again, more benefits for you to access retirement assets, although that comes at a cost because you're losing that tax-deferred buildup. We'll talk more about this when we get into investments. So let's shift now to managing your cash flows. And the first step in doing that is really to identify what are your needs, your spending needs, and what are your spending wants. And while that sounds like it's easily identified, it's not. And you have to sit back and you have to think about what exactly do I need if in fact cash flows are constrained versus what would I want? Because the want is a discretionary spending call. And as you see, when you proactively take control of how you use your money, you decide what to spend it on. And the first step to think about is the discretionary spending. Can I put that off for a while until when we come out of this crisis, till my job is restored? Cash flows are in that regard right there. You can control your variable fixed a little bit. Maybe you can negotiate some discounts. You could reduce W-4 withholdings. Now, you did this when you first started working with somebody. If in fact you're furloughed or you've lost wages due to reduced hours, you could go back in and refile your W-4 so that the withholding amount every paycheck is less because your tax liability at the end of the year you expect to be less. You could make minimum debt payments. A big idea that we'll talk about is debt restructuring. Your ability to take advantage of some opportunities here to start paying some lower payments on your loans. And finally, there are some temporary debt relief from the government. This is federal student loans. We'll talk about this in a moment. And also expanded debt relief for some other situations. So if you have a challenge in paying bills, first you assess your situation. Determine your ability to pay. 2, contact the companies, your creditors, to discuss hardship repayment options. They are there. Many companies will extend grace periods. They'll talk with you about revised repayment schedule, maybe postponing a couple and pushing that to the end of the payment schedule. There's opportunities to do that. And 3, understand the consequences of repayment schedules. Some of those hardship repayment options were not supposed to make it to the credit score. Some of them did. So you want to make sure of that. One other thing I want to point out here, if your cash flows are constrained and you're not able to pay your end of year taxes, file anyway. The penalty for filing and not paying at the same time is much less than not filing at all. Go back here. For those of the small business, I refer you to this slide, and you're quite aware of the Paycheck Protection Program and the PPP Flexibility Act, which extended that. But here's some information on what was done for small businesses. Now let's go back to that idea of how can you take advantage of the situation with mortgages and some of your debts. And we can take a look at the low interest rates. Interest rates are extremely low. Has given you the opportunity to replace some high cost debt with lower cost debt, including refinancing a mortgage, or if you have equity in the home, the idea of refinancing the home with cash out, pulling out some of that equity to pay down higher cost loans. If you have a pretty good credit score, you could shift around your credit card transfers. You could, for a year, maybe get 0 interest on it to pay off higher cost debts. You can take advantage of the low interest rate environment to start to reduce some of your cash outflows. Again, you are in control of the cash flows, and restructuring your loans is a big way of doing that. Also, you could extend the duration of the loan. That will simply mean that the monthly payment is going to be less, and in combination, that can be quite effective. Now, the CARES Act also provided some additional debt relief. For federal student loan repayments, for you with students, for those of you with who have student loans, your loan repayments were suspended until the end of September. During this period of time, it acts as a deferral in which no interest accrues. Any payments made during the period simply reduce the principal. So it temporarily postponed that, no interest accruing during the period. Also, collections on defaulted loans are suspended. Mortgage payment relief. Now, this includes federally backed mortgages, including FHA, VA, Freddie Mac, Freddie Mae. And this contact the loan servicer. You'll then get an 180-day forbearance. A forbearance means that you don't have to make any payments for those 180 days, those 6 months. However, interest does accrue. And it also gives you the right to extend it for a full year. So as you take a look at this slide right here, you see that there are more opportunities, again, with the CARES Act to help with the cash flow situation. Building emergency funds and accessing your credit. Now, emergency funds offer liquidity. Liquidity is a concept about how quickly you can access cash. And it's accessing the cash so that if there's $1 there, you get basically $1. It's not subject to market volatility. And the cost of transferring that asset to dollars is quite cheap. The CFP board and many financial planning advisors would recommend 3 to 6 months of emergency funds. You're given a range because it really depends on the family situation. Is there one breadwinner, two breadwinners? How many children? What are the responsibilities? How quickly can they get a new job? During a period of crisis, you might consider increasing this to 6 to 12 months. Why? Because the job prospects might not be, the ability to replace that job is not going to be as easy as it was before. The problem with emergency funds is they pay a very low level of interest. They include depository accounts, checking, savings, now accounts, money market accounts, certificate of deposit, savings bond, very low interest that you're earning in that regard. You could, so you think about what are some other ways of building flexibility into your plan to provide access to funds if you need them without sacrificing the opportunity of making more money by investing some of that money elsewhere. And the areas that you might consider are lines of credit, whether a bank line of credit or a home equity line of credit. You could borrow against the cash value of your life insurance. You could take a loan against retirement, or you could take IRA withdrawals from either a traditional IRA, there's some tax implications there, or the Roth IRA. You could also pull out of your employer plans where you contributed money, including a 401k, 403b, 457. So the sources of emergency funds you can create include more than just taking the excess cash and putting them into a bank. So you start, again, integrative planning, achieving the need to make sure you have access to liquid funds at the same time making some income. Credit comes with a high cost. However, given the situation that your cash flows are really short and you've got some short-term goals and needs, you may have to use the credit. That's what it's there for. Now, as you use more credit, it impacts your credit score. The FICO credit score is quite important because that will impact your future cost of debt. It will impact your ability to get additional debt. However, you may need to do it. And then later, rebuild your credit back up if that's the situation, and you rebuild your credit by simply making timely payments, stay in touch with your creditor, get organized, and rebuild that again. And for many of you, as the jobs come back online, if your job right now has been hit, that can be rebuilt within a relatively short period of time. Now, risk management. We said before, you can't forget about risk management. As we think about building your estate, building wealth over time, that foundation piece is risk management and insurance. Without that there, everything else can collapse. So the idea is you have to make sure that you've insured against possible outcomes that could, like a liability lawsuit, the complete burning down of your home, causing an auto accident where you are liable, to make sure that the insurance is there to keep your estate intact. So this is the foundation. So catastrophic exposures include potential healthcare costs, premature death on the surviving family, loss of income due to disability, and liability lawsuits. So many of you already have this in place. However, if cash flows are constrained on the crisis, you need to take a look at ways of making sure that you're maintaining those key coverages. Two of the coverages which could potentially disappear is the loss of your employer benefits in regard to health insurance and group life insurance. Now, if there's a furlough, generally the employer is going to continue to provide health care benefits for 12 months. You pay your portion, they continue to pay their portion, and group life, generally, the employer continues to pay these premiums for 12 months. Not always the case, but that's the general situation. If you lose a job, then you're going to have to replace the healthcare insurance. COBRA is there. You may have heard of COBRA before. It allows you to continue coverage of your employer's policy, but you pick up the premiums. A eligible qualifying event, gives you up to 18 months of coverage under the former group plan. The pandemic has changed things up that now COBRA's sign-up period is extended to 60 days after the official end of the outbreak period, and then you would have 8 months, 18 months after that. Alternatively, you could switch to your spouse's plan if he or if she or he is still are working right now. You could apply for your own healthcare coverage. With the group term, you're going to lose that once you leave employment. In that regard, you could either try to convert it to an individual policy or go out and get your own. Now, if cash flows are constrained, part of the problem is, well, how am I going to pay the premiums? And to pay the premiums, you can see there are different ways of doing that. And I show some of that right here. One, you could think about term insurance is absolutely the cheapest form of life insurance. Why? It's strictly life insurance. There's no savings there. So if you needed additional coverage, that's going to be the cheapest way to go. And if you're young, it is very, very reasonable, right? If there's permanent life and you're having problems maintaining the premiums, you could, one, surrender it, get the money, use that to buy term. You could potentially use it to elect a paid up policy with a lot smaller death benefit, or use the money there potentially to get a paid up term policy. So maybe the cash value will buy you 3.5 years of term. Disability insurance, in this regard, you can control the premium by changing the waiting period, the duration, the amount of the benefit. And of course, auto and home, you could, in that regard, increase the deductible, which will reduce the premiums a little bit. A couple ideas if cash flows are a problem. John Scrogan, who was a speaker at one of the national conferences, said estate planning is all about the living, not the deceased. And it's a quote that I use in all of the classes when we talk about life insurance and estate planning. Estate planning, in this regard, you may want, it's prudent right now to update your estate documents. Take a look at the will, powers of attorney, healthcare directives to see if they in fact still achieve your objectives regarding your family boundary right now and your goals. Check the beneficiary designations and property titling, and replace that group life insurance if you lose that if you lose a job. Why? Because life insurance is how you leverage the estate. Investing during times of volatility. Now, market volatility really kicks up in the face of uncertainty. The markets, there's a Wall Street saying that simply goes, the markets hate uncertainty. And as you can see from this chart, over the last few years, volatility really spikes when uncertainty kicks up. Uncertainty forces selling, right? And you can see that there's another older chart right there from Fidelity, 1928 to 2008, which just shows the days where there was greater than 3% moves in the major market index. If you have a long-term horizon, this volatility, this type of selling does nothing to your plan. As was discussed in a few moments, it actually helps you as you move along. Again, you have a long-term goal. Nothing has changed with market drawdowns. You have to be in the market if, in fact, you are planning for those retirement goals, those future spending, because you can see right here, the equity markets have outperformed the other asset classes to a major extent. And after taxes, it's even more apparent. You can see the way that stocks have outperformed bonds, bills, inflation. But realize, the market is not straight up, it's not sideways. There are cycles, there are business cycles, there are ebbs and flows. Now, as you look at this chart right here, you see that the average appreciation during the bull market, in other words, that period of time that the market is going up, has been 148%. The average depreciation in the bear is minus 31%. Also from this, you see that there are more up years than down years. The economic power, might, momentum of the US market is something that you need to participate in. And you can see right here, and you need to keep that in mind during times like right now, where fear and uncertainty are extremely high. Now, the table on this slide summarizes a seminal study by Brinson, Singer, and Biebauer. This is a study which really tipped financial planning on its head when it came to investing. And the impact here was that 91% of your future wealth accumulation is related to the asset allocation decision. 91%. It's not the one security that you purchased to add to your portfolio. That was 4.6. It wasn't trying to time the market. That was 1.8. It was figuring out how much of your money needs to be invested in growth, fixed income, cash equivalents, for example, maybe real estate. That was the major driver. And there's a saying that I hope that you remember. It's not about timing the market. It's about time in the market. Leaving your assets in play during a time like this can be beneficial for the future outcome. Why? Because of compounding. Now take a look at this study by Dalbar. Dalbar is a marketing firm out of Canada. And the first time I saw this, I just sat up and went, whoa, right? Maybe you did too. They looked at the market over a 20-year period. And the total market returns for the S&P were 11.9% per year. Annual percentage rate, 11.9. Inflation ran at 3% during this period of time. Treasury bills, risk-free treasury bills, issued by the US Treasury, durations less than a year, 4.6%. They compared that to how individual investors did over that same period of time when they timed their market. Average return for the equity investor, 3.9%. The average return for the fixed income investor, 1.8%. Buying and selling at the wrong time. The idea, those numbers just sitting in the S&P, they would have compounded at 11.9%. It's hard when you're in the middle of the volatility, when you're watching the news and you see all the gloom and doom and the fear that's out there, but you need to realize that if your time horizon is way down the road, you need to stay in the market, time in the market. Look at this chart from Charles Schwab. If you miss the top 10 days, now this was 1999 to 2018, the average return, 5.6% compound return each year. If you miss the top 10 days, your average return was 2.0. If you miss the top 20 days, you're in the negative category, and it goes negative from there. Timing the market may work on one occasion, but over time, it ends up being a losing game. And that's why you need to think about staying the course with your assets and as you move forward, particularly with a longer time horizon. Another reason that you stay is dollar cost averaging. If you're allowing dividends and capital gains to reinvest, you're investing, for example, in mutual funds, or you're taking some gains off of some of your other assets and reinvesting it again. As you can see here, it allows you to, every time the market goes down, you buy more shares for a set amount of money. This is called dollar cost averaging. It's a formula designed for individuals to engage in systematic investing over time. Keep investing, whether it's every quarter, every month, every 6 months, and regardless of what the market is doing. Because that allows you, again, using this money to accumulate more shares. And as you see here, the dollar cost averaging share per share price is lower than the average cost. One final thought here with investing. Diversification does help to smooth out the ride. So if you're investing, you see this chart, a combination of stocks and bonds, along with holding just the all stock portfolio. you can see that they can appreciate at different times, but notice on this chart that over time, they got to just about the same level, a lot less volatility with the diversified portfolio. And you can't just think about return by itself. You think about risk return. You think about the sleep factor. If it's an easier ride, you're more inclined to stay the course. The message here then with investing is that idea to volatility is part of the markets. Ups and downs are parts of the market. You need to be there to participate. Now, a couple final thoughts here with retirement planning during this time of crisis. If possible, always take advantage of your employer matching dollars. I know it's difficult sometimes to say, wow, maybe not today I want to invest, but you're leaving money on the table, free money on the table. You need to do that. Given cash flow constraints, maybe you defer contributions to your IRA to make sure you put them into the employer plan that's being matched. Retirement plan withdrawals, as we said earlier, CARES Act has provided you the ability to take out some withdrawals with the ability to sidestep some of the taxes, right? And that's quite useful, but remember, there's immediate tax consequences on that tax deferred growth of all your assets, and you're losing that future benefit. So you need to weigh the pros and cons of pulling some money out today versus trying to let that grow. What are a couple of the other CARES Act laws with retirement? This is passed, but you know July 15th was the extended IRA contribution deadline. RMD for this year was waived. Now, once you get to be 72, those who turned 70 and a half prior to the start of the year, they had started, but it's now 72. You have to take out required minimum distribution. What that means is they're looking at the expected life expectancy, how much you're in the plans, you're taking out an amount per formula every year. And if you don't, there's a 50% penalty. If that happens once, you will remember it. Point being here, you don't have to do that. And if you took out any of your RMD from January to March, you can roll that back in by August 31st. And 2020 does not count in respect to the 10-year distribution rule for beneficiaries of retirement plans. There's an opportunity, if possible, and you're in a situation, and rather than taking the RMD, which you would have taken out prior to this act, consider maybe taking that amount of money and doing a Roth conversion. So you're still managing your tax bracket, you're shifting more money over into tax-free future income. Let's conclude these action steps with supportive mindsets during periods of uncertainty. Emotion can really disrupt the decision. So under periods of high uncertainty, cognitive and emotional biases can really cause some problems. And this was a chart from the CFA presentation a few years ago that shows the typical cycle of emotions through the business cycle. And clearly when you get into these different areas, you can see how these move over and over again. George Soros once said you can't time the market, but you can time human emotion, because human emotion follows a very, very repetitious system here. Well, same type of emotion flows into transitional events in our clients' lives, including divorce, loss of a spouse, issues like that. And what happens here during periods of the severe stress, there's this fight or flight mentality, a narrow myopic focus, the ability of fears can start to take over, the lost possibilities, feeling a victim, getting anxious, right? The stress kicks up. So it happens in any type of crisis. And clearly for some right now with COVID, this can come into play. So what are some of the ways to manage anxiety during the healthcare pandemic? One, resist the worst case thinking. rather than thinking worst case. Think about what threats are immediate, possible, likely. Remember, this health crisis will pass. The economy will recover. Accept the reality of the situation and focus on what you can control. What are things you can control? The way that you're approaching taking care of yourself. Health actions and precautions, including social distancing and masks. Prepare for possible scenarios. Some may say that if they have a family member, how are they going to quarantine them? So you're starting to take action and make informed financial planning decisions. And I hope some of what we talked about today will help you start to think about those issues and embrace resiliency. If you can, start to build flexibility into your plan. Emergency funds, lines of credit, health savings accounts, Roth IRAs. These are all ways to start to build flexibility into your plan and stay informed of what's going on in your community, what's going on with government support throughout all of this, and again, focus on your health, your level of stress. A few final thoughts before we get to question and answer. Talk about one. Cash flow challenges may force you to shift your focus, at least temporary, to short-term needs. If that's the case, you know cash flows are going to be king. Cash flow will be king in that situation. You are in control of your money. You decide how you're going to spend it, what it's going to be spent on. You've got the ability to leverage some benefits that are being provided by the government. If you're an employer, leverage your employer benefits and take advantage of opportunities. Look for them. And one of the huge ones right now is the very, very low level of interest rates. The ability for you to restructure your debt balance sheet. Build adequate sources of emergency funds, including those depository accounts, including those ability to access funds if you need them. Remember to manage your risk exposures. Maintain that insurance which covers catastrophic risk. You may have to adjust it slightly for the premiums, but make sure it's in place so that everything wouldn't collapse if the worst scenario happened. Continue to invest if at all possible. As we discussed today, it pays in the long run. Market volatility will only benefit you if, in fact, your vision is well down the road. You see, you have to be invested in growth because of the returns. And finally, it all comes down to mindset. You know, your ability, you're not a victim of this, you're in control. We're going to emerge, and hopefully the information here will help you as you do that. Well, there's a few resources right here. If you look for other resources, please let me know. And with that, we get to our question and answer, and I hand this back to Amanda. Amanda, all yours.
Great, thank you, Harry. As a reminder, if you have a question for Harry, please submit it through the Q&A interface, and we will ask. See, we've got a few questions streaming in already. Eli asked, if I am unemployed and have extra cash right now, what should I be doing with that cash?
So if you're unemployed, that may force you to then think about the short term, right? So in that case, you're going to have to keep that in emergency funds, at least for however long you think it will take until you do get employed. So we're recommending that you see that 6, maybe as long as 9 or 12 months, you may need to do that because the job market is uncertain. If in fact you see that the job is on the short horizon, maybe you can shorten that up, but you need to maintain some emergency fund.
Okay, thank you for that. Next, we have a question from Stephanie. She asked, what is the likelihood of a catastrophic financial system failure where consumers cannot access bank accounts?
Well, I think it's relatively low. Now, any scenario has some probability. Realize the U.S. economy is quite powerful. Once we come out of this, there's going to be a lot of pent-up demand. And you can see, even though there is discussions, bipartisan discussions in Congress, there is support coming from there. So I think that would be a low probability. If you go back into history, even with the Great Depression, we emerged from that.
Great, thank you for that. Next, we have a question from Reed. He says, why do capital gains in IRA accounts get taxed in the same way as the contributions get taxed when withdrawn?
Right? Because you were given a benefit up front. So when you have retirement accounts where you are allowed, either employer puts money in there for you that you're not taxed on, or you put money that you were never taxed on, and it builds up over time, you don't get a capital gain treatment in there. It's going to come out as ordinary income.
Okay, thank you. We have a question from Chris next. How do we manage our investments in alignment with our values these days?
So that's quite important. You need to think about one, when we think about investing, you think about one, your tolerance for risk. In other words, you invest down to your sleeping point where you would get so aggressive that you couldn't sleep at night, for one. Two, you think about your time horizon. And of course, you think about your values. Now, for some, it's like ESG investing, right? They want to be social, economic, environmental and social and governance, all the issues like that. Maybe that would help. Maybe that would align with what you want to do. Again, the tenets of investing come down to asset allocation and how much you can put into any one security. The values then, where would you that money would be invested? Socially responsible type funds might be an answer for you.
Okay, thank you. An anonymous attendee asked, could you talk more about mortgage refis? What has to be the decrease in APR to make it worth it, or how can I assess whether or not it's worth it for me?
So we used to, the rule of thumb used to be a 1% decline, but that's when we had mortgage rates in the 8%, 7% range. Now that they are so low, and that they are often rolled over for no cost. Of course, there's always a cost, the interest rate, but you might be refinancing your mortgage when you have as much as 3/8 to a half a percentage point change. So it really is, you simply take a look at the cash flows. What are you paying now? What will it cost you to get a new one? And what are the terms? The interest rates are so low that you may find yourself going from one mortgage to another every couple of years. Individuals have done. So you simply run the numbers and realize that when you refinance, you could, if you have a 30-year mortgage, you could refinance into a 30-year, or you could refinance into one that's less with that. So you can think about that. So my answer to you there, unlike before, there's no general guidance on how far. Simply take a look at your savings, cash flow savings for the year, and also over the life of the loan.
Okay, great. Thank you for that. Next, we have a question from Roger. He asks, what do you think of current market valuations and the likelihood that we're in a market bubble right now?
That's a really interesting question, right? We think about, gosh, what about the valuations here? The market really sold off quickly, really bounced back. There's a lot of opinion out there. Some thinking that we're going to go back down, maybe retest the lows. Other ones saying, well, we held up here. We might have a vaccine getting closer on the way. We see the support overseas that they're throwing more money into the economy to keep it going. It's a difficult question on both sides. So valuations may seem a bit rich, but we may emerge out of this sooner than people think. So good question.
Okay, thank you for that. Next, we have a question. For those of us in para or another defined benefit plan, how can I assess how much additional retirement investment I should do on my own to hedge against the defined benefit plan facing failure or decreased payouts?
Well, that's an interesting question. If you, in fact, start to think about, you always think about what's your vision for retirement? How do you want to live? What are you going to be needing on what will you need for each year to maintain your necessary living expenses, your fixed guaranteed income floor that you'll need, and also the growth for discretionary and other things that you want to do. You start there. And then you start to think about, well, if this is what I'm going to get from para now, along with your other benefits, Social Security, other sources of income, what could potentially be the gap? So one way you could possibly do that is think about some different scenarios. If I get the full amount from para, this is what I would need to fulfill that. If in fact they are cutting back, this is what I would need. And then between that, that gives you a range. And then you would sort of think about your risk tolerance, where you need to be in there, and your ability to build extra funds.
Great. Thank you so much for that comprehensive response. Taking a look at the time, we're going to move into our final two questions. Next question's from Harrison. He asks, will you talk about the benefits of having a majority of your emergency savings in a high yield savings account versus a normal savings account?
So with normal savings accounts, you're thinking about a bank. And with a bank, the savings account, it will pay a low level of interest, and it will allow you have to maintain a certain amount of assets in there. If they drop below that within the month, you don't get any of the interest itself. And there's a certain number of checks that you can write. As you start to move into higher ones, a money market deposit account, for example, now you're getting a little bit more interest there. However, less checks, higher account balances, right? So that's sort of what happens in a depository account. You can move over to mutual funds into a money market fund. There's different types right there. But remember, all of these accounts are designed to give you liquid assets. So you're not going to get very high yields on these. You can get incrementally high yields by giving up, one, the number of checks and some of the benefits you would get with them, and also the amount it takes to open the account and to maintain the interest. So, but all those are designed not to default on you.
Okay, great. Thank you for that. And then our final question today comes from Tom. He says, I'm retirement planning. My portfolio has lost value and I'm feeling overwhelmed. What would you recommend as next steps in general?
Right. So the first thing you need to think about is what is your projected timeline for retirement? If it is still 10, 15 years away, don't feel overwhelmed and frozen, because nothing has really changed. If it was next week, then there is more of an issue. One thing you could think about, if that was the case, is to have enough funds to help for a couple years and then keep investing the other. That's one approach right there. You have to think about your risk tolerance, how much you've lost, and think about the situation. As you think about retirement, one of the things is try to build that guaranteed income floor. That would be Social Security, maybe your reverse mortgage, maybe if you had annuities in there, other areas like that which allow you to get you what you need to live on. Then you have your growth portfolio. And if you have enough to get by on your living needs, then simply continue to allow some of that growth portfolio to work for you and to compound. So I really would need more information on the situation, but I hope you get the idea on how you would approach that.
Great. Thank you for those ideas there, Harry. And I want to say thank you so much to everyone for joining us for today's presentation. And thank you again to Harry for this great information. As a reminder, all webinar attendees will receive an email tomorrow with a link to the recording of this presentation. To view upcoming webinars as well as previous recordings, please visit our website at colorado.edu/business/alumni. Have a great rest of your day and go Buffs.